The system you were taught to trust is actively working against you. Right now, as you hear these words, a mechanism older than most modern democracies is quietly transferring wealth from your bank account to institutions you have never met. This is not conspiracy. This is arithmetic. And the most alarming part is that regulators understand exactly what is happening. They designed it this way. What follows is not financial advice. It is a forensic examination of a system that punishes savers and rewards debtors. A system where keeping money in a bank account is not a neutral act, but an active financial loss. The data exists. The patterns are clear. Yet public discourse continues to frame saving as a virtue. This disconnect between reality and narrative demands investigation. The anomaly first appeared in academic papers during the late 1970s. Economists at the Federal Reserve Bank of St. Louis began tracking what they called the real return on savings. The findings were disturbing. In certain periods, particularly during the 1970s and again after 2008, the real return on cash savings turned negative. Not slightly negative, dramatically negative. $1 saved in 1973 was worth approximately 62 cents in purchasing power by 1982. The money did not disappear, it was transferred. This transfer mechanism operates through a process called financial repression. The term was coined by economists Edward Shaw and Ronald McKinnon in 1973. Financial repression occurs when governments deliberately keep interest rates below the rate of inflation. The purpose is straightforward. When your savings earn 2%, but inflation runs at 7%, you lose 5% annually. But you do not notice because the nominal number in your account stays the same, or even grows slightly. This is not a bug in the system. This is the system, functioning exactly as intended. The historical precedent is instructive. After World War II, the United States and United Kingdom both carried debt loads exceeding 100% of their gross domestic product. Direct default was politically impossible. Hyperinflation was economically dangerous. So governments chose a third path. They capped interest rates while allowing moderate inflation to persist. Over 3 decades, from 1945 to 1975, this combination reduced the real value of government debt by approximately 40%. The cost was borne entirely by savers. Not a single policy paper of that era acknowledged this as a deliberate strategy. It was simply called responsible monetary management. To understand why saving money functions as a trap, we must first understand how money is supposed to work. Consider money as a battery. When you work, you generate economic energy. You cannot use all that energy immediately, so you store it. In a functional system, that stored energy should remain intact. A battery sitting on a shelf should hold its charge. The dollar you earned through labor in January should purchase roughly the same amount of goods in December. This is the implicit promise of currency. Store your productivity now, retrieve it later. The Federal Reserve, which is the central bank of the United States, has an explicit inflation target of 2%. This means the official policy is to reduce your purchasing power by 2% every year. Compounded over 30 years, this results in approximately 45% loss of value. $1 saved in 1994 could only buy about 55 cents worth of goods in 2024. This calculation uses the Federal Reserve's own preferred inflation metric. The actual erosion using alternative measurements is significantly higher. The first anomaly concerns official inflation measurement. The Bureau of Labor Statistics calculates the Consumer Price Index using a methodology that has been revised multiple times since 1980. These revisions are technical, but their cumulative effect is substantial. The introduction of hedonic adjustment in 1998 allowed statisticians to reduce measured price increases for products whose quality improved. A computer that costs $1,000 this year but is faster than last year's model might be recorded as having declined in price, even if you still paid $1,000. Substitution effects were also incorporated. If beef prices rise, the assumption is that consumers switch to chicken, so the beef price increase is partially excluded from the index. John Williams, founder of Shadow Government Statistics, has reconstructed inflation using pre-1980 methodology. His calculations show that actual inflation has averaged between 5 and 8% annually over the past 2 decades. If accurate, this means the real return on savings accounts has been -8 to 10% per year, not the 1 or 2% suggested by official figures. This is not a fringe argument. The methodology differences are documented. The Bureau of Labor Statistics publishes its formulas openly. The question is not whether the calculations changed. The question is whether the changes reflect reality or convenient fiction. The second anomaly involves interest rate policy since 2008. The Federal Reserve maintained near-zero interest rates for approximately 7 years following the financial crisis. Then again after the pandemic in 2020. During these periods, the average savings account yielded approximately 0.06% annually. Simultaneously, the Federal Reserve's own balance sheet expanded from approximately $900 billion in 2008 to nearly $9 trillion by 2022. This expansion was achieved by creating new money to purchase bonds. The mechanism is called quantitative easing. Here is the arithmetic that is rarely discussed publicly. When central banks create money to purchase assets, those assets rise in price. Stocks increased. Real estate increased. Bonds increased. Those who owned these assets before the money creation saw their wealth expand. Those who held cash saw their relative position decline. A person who saved $100,000 in 2010 and kept it in a savings account had approximately $100,000 in 2020. A person who invested that same amount in the S&P 500 index had approximately $360,000. This is not a commentary on investment skill. This is the direct mathematical consequence of monetary policy favoring asset holders over cash holders. The third anomaly concerns bank profitability during periods of low interest rates. Commercial banks earn money through the spread between what they pay depositors and what they charge borrowers. When rates are near zero, you might expect bank profits to compress. The opposite occurred. J.P. Morgan Chase reported record profits in multiple years following 2008. Bank of America similarly. The mechanism is subtle. Banks paid depositors nearly nothing, but they invested those deposits in higher-yielding instruments, often purchased with the assistance of Federal Reserve liquidity programs. The spread widened, not narrowed. Your 0.05% savings account funded bank profits, while inflation eroded your principal. The fourth anomaly involves the relationship between government debt and interest rate policy. The United States government currently carries debt exceeding $34 trillion. At 5% interest, annual interest payments would exceed $1.7 trillion. This approaches total federal discretionary spending. At current elevated rates, the Congressional Budget Office projects interest payments will exceed defense spending within 5 years. There exists an undeniable incentive for policymakers to keep rates low, regardless of inflation. Every percentage point reduction in rates saves the federal government hundreds of billions annually. The cost is externalized to savers. The fifth anomaly concerns the messaging surrounding savings. Financial literacy programs, often funded by banking institutions, consistently emphasize the importance of emergency funds and savings accounts. These programs rarely mention the mathematical certainty of purchasing power loss. The Federal Deposit Insurance Corporation, or FDIC, guarantees deposits up to $250,000. This guarantee creates psychological safety. Your money cannot disappear through bank failure. But the guarantee says nothing about purchasing power. You are guaranteed to receive the same number of dollars, not the same value. The distinction is critical. The sixth anomaly involves real estate and rental markets. Since 2012, institutional investors have purchased over 350,000 single-family homes in the United States. Companies like Blackstone, Invitation Homes, and American Homes for Rent transformed what was previously an individual asset class into an institutional one. The Federal Reserve's low-rate policy made this acquisition strategy possible. Institutions borrowed at 2 to 3% to purchase assets yielding 6 to 8% in rental income. Individuals attempting to save for down payments found their targets moving further away each year. Home prices increased faster than wages. The gap between savers and owners widened systematically. The seventh anomaly concerns asset price inflation versus consumer price inflation. Central banks target consumer prices, a basket of groceries, utilities, and services. But much of the created money flows into asset markets first: stock markets, bond markets, real estate. These are not included in consumer price indices. A person measuring their well-being by consumer prices might see moderate 2 to 3% inflation. A person measuring by the cost of acquiring assets sees a fundamentally different reality. The median home price in 2010 was approximately $220,000. By 2024, it exceeded $420,000. This 90% increase does not appear in inflation statistics because houses are investments, not consumer goods. The eighth anomaly involves generational wealth transfer. Baby boomers accumulated assets during decades of declining interest rates. Each rate decline increased the value of existing bonds and supported rising stock and real estate prices. Millennials and Generation Z entered the labor market when rates were already near zero. Further declines were impossible. Their savings earned nothing, while asset prices continued rising. This is not merely an economic observation. It represents a structural transfer from young to old, from workers to owners, from savers to holders. The mechanism is invisible because it operates through purchasing power rather than direct taxation. Consider two possible explanations for these patterns. The first path suggests incompetence and complexity. Financial systems are genuinely difficult to manage. The Federal Reserve faces competing mandates: maximum employment, stable prices, moderate long-term interest rates. Trade-offs are inevitable. Measurement methodology evolves as economies change. Post-crisis policy required extraordinary measures. Side effects were regrettable but unavoidable. This interpretation assumes good faith and imperfect execution. The second path suggests intentional design. Financial repression has historical precedent as deliberate policy. Government debt levels make alternatives politically impossible. Low rates benefit the financial sector, which employs significant lobbying resources. Wealthy individuals disproportionately own assets, while middle-class wealth concentrates in cash and home equity. The complexity of the system provides cover for policies that would be rejected if stated plainly. This interpretation assumes that consequences align with beneficiaries' interests, which rarely occurs by accident. Evidence supporting either interpretation exists. Transparency advocates point to Federal Reserve meeting minutes that discuss inflation targets and employment mandates without mentioning saver impacts. Critics point to the same documents, highlighting awareness of distributional effects that are never addressed. The truth likely contains elements of both. Systems can be both incompetent and captured. Policies can be both well-intentioned and beneficial to specific interests. The search for clarity leads to specific data sources. The FRED database, maintained by the Federal Reserve Bank of St. Louis, contains historical interest rates, inflation measures, and money supply figures. Cross-referencing these datasets reveals the magnitude of the transfer mechanism. The Securities and Exchange Commission, or SEC filings, show institutional investment patterns in residential real estate. Academic papers from the Bank for International Settlements, often called the Central Bank of Central Banks, discuss financial repression openly in ways that domestic central banks avoid. The response from global institutions to these patterns has been notably muted. The International Monetary Fund has published working papers acknowledging financial repression as a component of debt management strategy. The European Central Bank, or ECB, implemented negative interest rates in 2014, explicitly charging banks for holding deposits. This policy transferred directly to retail savers in several European countries, who faced negative yields on savings accounts. The Bank of Japan has maintained near-zero rates for over 2 decades, producing what economists call the lost generations. Young Japanese workers saw wages stagnate, while housing in Tokyo became increasingly unaffordable. Coordination among central banks raises additional questions. The Federal Reserve, ECB, Bank of Japan, Bank of England, Swiss National Bank, and Bank of Canada established permanent dollar swap lines during the 2008 crisis. These mechanisms allow rapid coordination of liquidity provision across borders. The stated purpose is financial stability. The effect is synchronized monetary policy that leaves savers globally with few alternatives. A German citizen earning negative rates on euros cannot easily escape to dollar savings when the Federal Reserve simultaneously pursues low-rate policy. The trap is international in scope. The question of intent may ultimately be unanswerable. What can be measured is outcome. Since 1971, when the United States ended the gold standard and currencies became purely fiat, the purchasing power of the dollar has declined by approximately 86%. This is not disputed. The Bureau of Labor Statistics publishes these figures. A dollar in 1971 bought what 17 cents buys today. Someone who saved $100,000 in 1971 and kept it in cash would have approximately $100,000 today. But that money would purchase what $14,000 purchased then. Meanwhile, the stock market increased from approximately 800 points to over 40,000 points. Real estate in major metropolitan areas increased by similar multiples. Gold increased from $35 per ounce to over $2,300 per ounce. Every asset class increased in dollar terms, except for the dollar itself. The asset that lost value was the one that ordinary people were encouraged to save. The new rules of the financial system are not published in any handbook. They must be inferred from outcomes. Rule 1. Holding cash is a guaranteed losing position over time horizons exceeding 5 years. Rule 2. Asset ownership matters more than income for long-term wealth building. Rule 3. Access to leverage at preferential rates separates winners from losers. Rule 4. Official statistics measure what is convenient, not what is comprehensive. Rule 5. The system rewards those who understand it and punishes those who trust its stated purpose. None of this constitutes advice to take any particular action. These are observations about structure. A map is not instructions. Understanding that the road slopes downhill does not tell you whether to walk, run, or find a different path entirely. What it does is replace false assumptions with accurate assessment. The assumption that saving money preserves wealth is mathematically false under current conditions. This matters regardless of what you choose to do with that information. The uncomfortable possibility is that regulators understand all of this perfectly. The Federal Reserve employs over 400 PhD economists. The complexity of these dynamics does not exceed their analytical capacity. The Bank for International Settlements has published papers explicitly modeling financial repression scenarios. The information is not hidden. It is simply not emphasized. Press conferences discuss employment statistics. Public statements address inflation in the abstract. The distributional consequences of policy choices receive minimal attention. Perhaps this is political necessity. A Federal Reserve chairman who stated plainly that current policy transfers wealth from savers to asset holders would face immediate political backlash. So the transfer continues under technical language. Quantitative easing, forward guidance, yield curve control. Each term describes a mechanism that affects purchasing power. None of the terminology makes the effects legible to ordinary citizens. The question that remains is whether this represents system failure or system success. If the purpose of monetary policy is price stability and full employment, the results are mixed at best. If the purpose is debt management and financial sector stability, the results appear more intentional. The answer depends on which stated purpose you believe, and whether you consider unstated purposes that align more closely with observed outcomes. Financial systems can be reformed. They have been reformed multiple times throughout history. The Bretton Woods Agreement after World War II, the Nixon shock of 1971, the Basel Accords for banking regulation. Each reform reflected the priorities of its moment. Each created winners and losers. The current moment carries its own pressures. Unprecedented debt levels, demographic aging, technological disruption. Whatever system emerges from current conditions will similarly reflect those pressures. What savers face is not a temporary anomaly, but a structural feature. The tools available to central banks to manage modern economies systematically disadvantage cash holders. This may be regrettable, but necessary. It may be intentional, but unacknowledged. It may be neither, and simply an emergent property of complex systems that no one fully controls. The data does not resolve this question. The data only confirms that the transfer mechanism exists and has operated for decades. The final observation concerns trust. Financial systems operate on confidence. The dollar has value because people believe it has value. Banks function because depositors believe withdrawals will be honored. Markets clear because participants believe prices reflect information. When the gap between stated purpose and observed outcome grows too wide, confidence erodes. Not suddenly, not dramatically, but steadily. The greatest risk may not be inflation or rate changes or any single policy decision. The greatest risk may be the slow accumulation of awareness that the system works differently than advertised. Each person who realizes that saving money is a losing strategy adjusts their behavior. Multiplied across millions of individuals, those adjustments change aggregate patterns. Banks see deposit outflows. Asset prices inflate further. Inequality compounds. Whether regulators are monitoring this erosion of trust remains unclear. Public statements suggest confidence in the system's resilience. The same confidence was expressed before the 2008 crisis and before the savings and loan crisis of the 1980s, and before the inflation spiral of the 1970s. The pattern is familiar enough that its repetition should prompt caution. The information presented here exists in publicly available sources: Federal Reserve databases, Bureau of Labor Statistics methodology papers, academic research from respected institutions. The conclusions are interpretations, and reasonable people may disagree about their implications. What cannot reasonably be disputed is the arithmetic. Cash savings have lost purchasing power consistently for over 50 years. Policy has consistently favored asset appreciation over purchasing power stability. The distribution of those effects has consistently favored holders over savers. You were told that saving money was responsible. You were told that compound interest would work for you. You were told that keeping an emergency fund in a savings account was prudent financial behavior. These statements were not lies in the conventional sense. They simply omitted the context that would have made the full picture visible. The question is not whether the information was hidden. The question is why you had to discover it for yourself, and what it means that financial literacy education funded by institutions that benefit from your savings behavior would not tell you directly that keeping money in their accounts guarantees you will have less purchasing power each year. That gap between what you were taught and what is true suggests either incompetence or design. The data does not distinguish between those possibilities. It only confirms that the gap exists and that someone profits from your presence on the wrong side of it.